Hello guys and welcome to another develop video. Today taking an in-depth look at McDonald's Corporation and Lowe's Corporation, both reporting earnings today. First of all, we're starting on McDonald's Corporation with a current price of $294 and a market cap of 211 billion. We'll first look at the business metrics. We can see that their return on tangible assets is 16%, which is really good. Their return on equity is negative, and this is, I suppose, from their buybacks because buybacks increase treasury stock, so equity goes negative, even though it's not necessarily a bad thing. Even Warren Buffett pointed that out. Current ratio is 1.16, which suggests very good short-term liquidity, and the gross profit and net income ratios are also pretty good. The return on equity or invested capital, sorry, is 17.7%, which is really good, and the cash per share is 6.29, which is okay, although it should have been higher for such a high price. First, let's do Graham's valuation using the revised formula. We can see that using the revised formula with their expected 2024 earnings per share, we get an intrinsic value of $276.2. Now let's go to the DCF and let's see, we get an average growth rate of 9.4%, and we'll do a 4% growth rate for the next 9 years, sorry. And then a perpetual growth rate of 2%, and using this averages, we get an DCF price per share of $124.33, so much lower than the current price. We'll jump over multiples and just go to the DDM, dividend discount model, and if the free cash flow grows at 4%, also put the dividend growth of 4%, because as we have seen, their payout ratio is 53%. And why does it matter? Well, 53% means that they probably won't increase the dividend that much, so they won't increase it to 60% payout ratio, but they'll probably keep it at this level. So I'll just increase the dividend in line with their free cash flow. And now going into the output, using grams, DCF, and ATDM, we get an intrinsic value of $180.50. Of course, the 15% margin of safety, the rule of thumb, we get an intrinsic value of $153.44, suggesting that the stock at the current levels is overvalued. Now, let's check out Lowe's Corporation. Lowe's Corporation, on the other hand, maybe it might be a different story. We'll see. As always, guys, you should do your own due diligence. It is very important to do your own due diligence because this is the only way you can make great investments. If you just only look at others, then your investments might not be the best. Now, Lowe's Corporation, their price is $87 with a market cap of 19 billion, so much smaller company. Their business metrics actually look worse than McDonald's. I mean, a 2% ROIC, that's abysmal, and their current ratio is 0.3, so much worse balance sheet. Now, I believe that they are a good play if they start if they start paying dividends, increasing their dividends, because their dividend payout ratio is only 4%, so they have a lot of room to grow here, a lot of room. That would be a great thing. And also we can see that their free cash flow yield is 20%, which is insanely good. Basically, they're trading at 5 times free cash flow. And yeah, I love free cash flow. I think everyone here does. Let's start with the Graham's formula. I couldn't find the Seeking Alpha 2024 estimate, so I'm using a estimated EPS average of 5.84. We get an intrinsic value of $137. Next, discount cash flow. The growth rate has been well, significant since, if we look from 2014, but if we look from 2015, it's been I guess a 4 to 5% per year, so from 2 billion to 3.2 billion. So we'll just put the average growth rate of 3.5% for the next 9 years, and we'll leave the perpetual growth rate of 2%. But because you can see that the free cash flow varies a lot, I'll just put a higher discount rate at 9% to make sure we account for that. We get an intrinsic value of $183. Next, let's go to the DDM. Well, the DDM I think is not warranted in this case because their dividend being so low. I'm not sure if they will increase it that much, so I will just leave it alone when calculating. And based on grams and DCF, so I think DCF usually does its job. Personally, I'm telling you from my past experiences, DCF is actually pretty good on its own, but also using grams revised formula, we get intrinsic value of $160, and using our 15% margin of safety, you get an acceptable bypass of $136, a lot above the current price. Actually, let's do a 40% margin of safety. I think that's a 45% margin of safety, which is insanely good. Of course, with your own DCFs, your own due diligence, because maybe there is something I didn't look at. This is only a short analysis. This is not an in-depth analysis. I do have a blog where I do in-depth analysis, but this is not on YouTube. I do not have the time. It takes a lot of time to do in-depth. So please make sure to check your own numbers, to do your own numbers. That way you can actually be sure of what you're going to get on your investment. Now, this has been it for today. I'm not sure if you noticed, but today we use ticker data. Ticker data is a great tool. Look, it actually gives you instructions for this thing. Uh, they, if any ticker you put in, so for example, I put in L from Loews Corporation, or I put in, for example, MSFD from Microsoft, I can easily get the data in real time. So this is really useful. Also, you can enter the fiscal year where you want to get the financial data. You have a lot of these templates for a lot of things. You actually have a DCF separate template, a DDM template separate from this one. So actually a very great tool. I recommend you check it out in the comment in the description below. And yeah, also do not forget to check my investing blog. It's also in the description. This has been it for today. I hope you've had a great day. I hope you've enjoyed the video. Do not forget to like and subscribe, and I'll see you on Wednesday. Goodbye.